Today, I got the three biggest Bitcoin stories you need to know. Bitcoin just blasted past $70,000 for the first time since June, up 15% since Monday, and it wiped out $3.1 billion in short positions in the process. Bitcoin's ETFs just had their best single day in 3.5 months. And a growing group of analysts is warning this whole rally could be a trap set for a crash to 44,000. Bitcoin surged to as high as 72,000 today, a 15% gain since Monday, and its first close above 70,000 since June. The move cleared the 200-day moving average near 69,000, a level that has acted as a resistance for months. Over the past 24 hours, 3.1 billion in bearish positions got liquidated versus just 277 million in logs. Bitcoin alone accounted for 1.8 billion of those shorts, with the single biggest liquidation a 48.8 million position on hyper liquid. Two things collided to cause this. First, the US Treasury announced doubling its long dated debt buyback from 2 billion up to at least 4 billion per operation starting on September 9, specifically to bring down Treasury yield that has hit 5.34%, their highest since 2007. Lower yields makes risk assets like Bitcoin more attractive. Second, President Trump publicly pushed Congress to pass a fair version of the Clarity Act and even said the government Bitcoin's holding have been talked about, language that the market reads as bullish. Combine a policy tailwind with a massive short squeeze and you get a move like this. US spot Bitcoin ETFs pull in 517.2 million on August 19, their best single day haul since roughly early May. BlackRock's IBIT alone accounted for 284.7 million, more than half of all demand that day. Ethereum's ETF added a smaller 17.7 million on top of that. This is the difference between a rally built on real money versus one built purely on liquidation. ETF flows are one of the clearest signals we have for actual institutional demand. The fact that this inflow landed right as Bitcoin was already testing the $70,000 level suggests real capital allocation lines up with the price move, not just forced buying from the squeeze shorts. That said, analysts are cautious about calling this the new trend, especially after just one day. The real signal comes from whether this inflows continues into the next week. Not everyone is celebrating. A number of prominent analysts are calling this rally a liquidity operation, not a demand signal, pointing to the Treasury bonds buyback program and the White House crypto push as engineered tailwinds rather than organic buying. One trader's roadmap actually called for this exact mode months ago, a squeeze towards $70,000 followed by distribution, then a final flush all the way down to the 44,000 to $48,000 zone. Adding to that concern, funding rates on perpetual features are sitting dead, usually a sign a real top is far away, but usually to see alongside such a sharp price spike. This is the healthiest skepticism worth hearing about. You get swept up in a green candle. The bears' arguments isn't that Bitcoin can go higher. Some analysts admit that all of this buying is making them seriously question their bearish theses. Their concern is about what happened after the squeeze. Driven buyers are done. If this move was mostly short liquidation and treasury driven liquidity rather than real accumulation, conditions that caused the pop could reverse just as fast. The bull case for continuation points to 74,000 to 95,000 next. The bear case points to a reversal back through 57 towards the 44,000. Both scenarios are on the table, which is exactly why this is a story to watch. So here's where we're standing. Bitcoin just blasted past 17,000 on a massive short squeeze. And Treasury driven tailwinds ETF just had their best day in months. And a chunk of analysts thinks this whole thing can reverse hard towards the 44,000. What to watch out for next, whether ETFs inflow keep up over the next few trading days, and how Bitcoin holds up now that the short squeeze fuel is running low. Those are the three biggest Bitcoin stories. I'll see you tomorrow.